Market action on Friday, February 8th was potentially important. Looking out 1 to 3 weeks, it did improve the odds of additional upside and risk assets. We'll also cover some bulletized items. Longer term, numerous concerns remain. To give you a visual of how things changed, Friday morning, early before the market opened, I went through all of our intermarket or ratio charts, risk on, risk off type charts, and made a list of ones that were leaning towards the bearish or I'm concerned camp and the ones that were leaning towards the bullish camp. The list was by far and away, as of the close on Thursday, slanted towards the I'm concerned camp. Friday, a lot of that changed. It was much more balanced. We'll show you QQQ as one example. As of Thursday's close, as of Friday's close, we'll also use tech ETF, the triple Qs, as a risk-reward example. We'll look at daily, weekly, and monthly DeMark charts. Then we'll take that concept of risk and reward, cover a spreadsheet, all of the major ETFs. We've got it sorted. It's a good starting point. I emphasize starting point. It's not a buy list. It's a list that we would use to scrub harder and much further. Currently, the odds looking out on numerous metrics tell us that we're almost at a coin flip stage. The odds are still decent that we go up, and they're still decent that we go down from here. And the gains, potential gains versus the losses, are relatively mixed. That's not really a good risk-reward ratio for investors. Bears need a catalyst of some kind. Here are some candidates. Would guess that something would have to happen in the credit markets or in the news cycle to flip the markets. Bulls in control, bears need a catalyst. Some other items that I don't really want to cover here. You can pause the video if you want to look at this. You can probably use Google to find out why some of these things are concerning. They all relate to a declining risk-reward ratio in terms of the balanced risks for upside potential and downside potential. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. This is a daily chart of QQQs as of Thursday's close. Point is, Thursday, candlesticks, a little bit shaky here. CCI, not very impressive. ADX, red over green. Come down here, MACD, we're in bearish cross mode. Nothing particularly exciting about RSI on Thursday, except that it's holding 50. That was a good sign. Rate of change, not very impressive. So on and so forth. Upside momentum, that's scary looking. Now let's see the improvement on Friday. Fast forwarding now, this is as of Friday's close, the same chart. So somewhat of a tepid candlestick formation. This looks a lot better. One reason to be cautious on Friday, if you draw a trend line here for QQQ, this is potential resistance, potential resistance, potential resistance. But that's an improvement over that, no question. Moving averages here, we're above them, they're turning up, that's a good sign. CCI looked tepid, now it looks a lot better. ADX, red was over green, this is a bullish cross on Friday, looks a lot better. You can see MACD here turning up. It's trying to make a bullish cross. That looks a lot better as well. RSI rising again. Rate of change held 0. That's got to start somewhere. TSI looks like it's trying to make a bullish cross. Ultimate oscillator tried to hold at 50. And momentum looked very tepid on Thursday and now went back above negative 20. So the point of the exercise is the odds of further upside improved quite a bit between the close on Thursday and the close on Friday. The basic theme of this video, and now we're looking at a daily chart for the triple Qs. This is a daily DeMark chart. DeMark charts and indicators are proprietary tools from Market Studies LLC. Our game plan, when we look at risk reward, we felt in this video the best way to communicate where we are to our clients and with people that are trying to learn is to look at our own thought process and why we've been a little hesitant to acknowledge real improvement and bullish conditions that are obviously still bullish. The bulls are in control. So we're looking at QQQs. If we see the traditional improvement on the chart that we just covered from Thursday to Friday, our next step would be to come to DeMark. Here's Friday, and you'll see this is a teal propulsion target. And what this tells you is this is potential upside. So there is some upside here. This teal target could act as resistance at 68.56, and these are also potential targets roughly at 68.76 and 69.07. This is known as a propulsion magnet here, so think of it as a magnet drawing price. Our concern is the downward magnet from a risk-reward perspective is all the way down at 63.49 on the QQQs. And we're using the QQQs here as an example. This basic concept applies to numerous ETFs and numerous markets. Not all of them. We'll show you some exceptions via a spreadsheet here in a little bit. So does it make sense from a risk-reward perspective for our time horizon? A day trader may want to take this. This upside relative to this downside is really not that attractive to our clients. They're investors, and we want to be able to hold a position for weeks to months. This is a position that looks like if these targets are hit and we do reverse, and we don't know whether they will or they won't. But what we can do is if QQQ is able to exceed these levels, then it becomes more favorable potentially to step in. Some other concerns, the DeMark counts. If you know DeMark or follow our videos, a 9 paired with a 13 tells you that this move off of the November low is potentially exhausted in this area. And think of it that we're running out of buyers, people to step in and buy QQQ at these levels. The buyers are becoming exhausted. This 13 is still in force under 68.40. The more you move over 68.40, the higher the probability that the triple Qs will move higher. That's the sequential count. And all this 13 and this 9 paired together, 9 and 13 tell us, is the probability of a reversal is heightened in this area as long as this line remains as a dashed line and is in force. That's sequential. Combo, active 913. This is still active here. Let's look at the aggressive combo. Here's your 13. The risk level's way up here. It's 69.33. What this tells you is on this count, you could go all the way up conceivably to 69.33. And what you'd want to see in a perfect world, if this is a good 9 and 13, is that we would never exceed this level. If we exceed it, it doesn't necessarily, in DeMark speak, or in DeMark's world, invalidate the 9 and the 13, but the probability of it being a good signal begins to diminish as you move above it. We can look at aggressive sequential. You can see here we closed below the risk level, a 9 and a 13 aggressive sequential. Your risk level, and think of this almost as a stop loss, that if you shorted QQQ after this 13, higher probability of a reversal, then in the easiest form you would hold on to that short. And we're not short any markets right now. We're basically in a high cash position. We haven't even bought bonds. We're in a neutral stance. But it tells you if you shorted here, that you would hold on to your short below 68.03 for the triple Qs. As we move above it, the probability increases that your short should be covered. Same concepts here. Now we've moved out to a monthly QQQ. You can see here there's a 9 and a 13. Eventually the QQQ's corrected here. It's a monthly chart, so that's a big move. We currently have a 9 paired with a 13 that's still in force here. higher probability of a reversal when you have the 13s. We also have on the propulsion end of the spectrum somewhat of a momentum hurdle to cross here at 68.56. If we were to buy the triple Qs, we would feel better if we could clear 68.56. Then the odds of hitting this upper propulsion teal target here of 75.82 would increase. But the 9 and the 13 here would also give us pause. Again, keep in mind that the concepts here that we're covering with the triple Qs can apply to numerous markets right now in terms of risk reward and concerns. This is the weekly triple Q DeMark chart. This is a mixed bag. A 9 paired with a 13 tells us there's a higher probability of a reversal. That would obviously be the potentially bearish end of the spectrum on this chart. Risk level for that trade is all the way up at 71.29. That's your pseudo stop loss for this 9 and this 13. On the bullish end of the spectrum, on a weekly chart, we held this green line for DeMark propulsion at 66.79. Theory tells us that above the green line, momentum may be strong enough to carry us to either 70.58 or all the way up to 73.54. Below the green line, from a momentum perspective, the probability picks up of moving towards the red magnet or the downside target of 63.49. Another piece of potential good news. This is a TDST level. If you don't know DeMark, just think of it as potential resistance. Here, the resistance level is 67.72. You can see we closed last week at 67.99 above that level. The longer we stay above it, the better. We'd like to see this line change to bold, which in DeMark speak would mean that this is a qualified breakout. We have a move above it, but it's not qualified, telling us that the probability of a reversal here is higher as long as this is a dashed line. Once it becomes qualified, the probability of either holding it or moving higher increase. And in DeMark's world, this TDST level is a trend change line. So if you can get above it and get a qualified breakout, it tells you that on this weekly chart, the trend is theoretically flipping from down back to up. Moving back quickly here to make a point on the daily version. If you follow our Twitter feed, you know potentially that I tweeted on Sunday that I was going to look at risk reward for all the major ETFs. Next, we're going to shift gears and show you that somewhat of the back of the envelope analysis for risk reward, but just want to show where the numbers come from. So when we look at the spreadsheet for QQQ, this teal target here is our upside potential from this close here to here, and my downside potential is this downside magnet at 63.49. And you can see that your upside is quite a bit less on a relative basis to your probabilistic downside. Again, keep in mind, when you're above the green, the probability of moving to the teal is higher than the probability of moving to the red at 63.49. Now let's look at the spreadsheet that shows these upside and downside levels for major ETFs. We won't spend much time here. This just shows you major ETFs. Here are the symbols. Black is where we closed on Friday. Red is your downside DeMark propulsion target. And teal is your upside propulsion magnet. We can calculate our upside potential versus our downside risk and come up with a risk-reward ratio. If we come to this sheet, we've simply sorted it by risk-reward ratio. Why did we do this? We did this to understand if the improvements that we saw in the equity markets can carry over to the credit markets, especially looking at credit spreads next week. The improvement that we saw from Thursday to Friday was mainly concentrated in the equity markets. The credit markets were still waving yellow flags. What we want to do, if the credit markets come over to the bulls side and they start acting more bullish for risk assets somewhere between Monday, Tuesday, Wednesday, Thursday, Friday of next week, we want to have an understanding of a potential short list of candidates to look at. So what this tells you is GDXJ, the ETF, has a potential upside, and this is somewhat of a back of the envelope calculation here, but it's a good place to start. This is not a buy list. This is a list where we would go looking and then go through the rest of our process, which is very rigorous for us. This is nowhere near a buy list. It's a starting point for a potential buy list. It tells you that GDXJ has upside of roughly 22% with limited downside as it sits on Friday. I want to emphasize that those targets with DeMark are active and fluid and they change. So as the markets change, DeMark software recalculates upside and downside targets. This analysis in this video is based on the targets as of the close on Friday. They could change, but we have to start somewhere, and this will be a good list to work off of. So my upside here is much, much greater than my downside here. General rule of thumb, these are the ratios. You would like to have your ratio, for the most part, be 3-to-1 in your favor. Your upside is 3 times greater than your downside. When you get below 3, but you're above 1, you're in kind of neutral territory, and anything that has a risk-reward ratio below 1 is suspect. So some to point out here, TLT, bonds, upside potential of 2.5%, downside potential of roughly 2.5%. Your risk-reward ratio is roughly 1 here. Commodities actually have a greater downside based on what we knew on Friday than upside. Small caps, IWM, downside roughly 6%, upside 3%. So could small caps go up from here? Absolutely. Could easily see them going up 3%. We could also see them dropping 6%, and that's not a very favorable risk-reward ratio based on how the markets closed on Friday. S&P 500, upside appears to be somewhere in the 1%, 1.5% range, downside somewhere in the 4 to 5% range, let's call it. The QQQs, again, emphasizing as they closed on Friday, subject to change. Remember, we looked at it and we saw that that teal target was relatively close by. It's less than 1% above, and the red target was quite a bit lower than price. It's down 6.62% from where we closed. This tells you is if I average all of these major ETFs here, the average upside is roughly 5%. The average downside is roughly 4.5%. Really not all that attractive. If you do it from a median basis, the median upside in this table here is 3%. The median downside potential is 4%. That's a risk-reward ratio below 1, really not that attractive. What does this tell us? It tells us that if we were to see improvement in the credit markets, an improvement in the general risk tolerance of the markets, or acceptance of risk, we might consider looking at these positions, but we would probably give any position a short leash, and your holding period here might be a week, it might be 2 weeks, it might be 3 weeks. The next question would be, well, why would you as an investor buy anything if you think you might only be able to hold it for 1 to 3 weeks? The answer is none of us can predict the future, and we don't know how things will evolve over the next 1 to 3 weeks. And it's possible that the markets go up for another 6 weeks or 12 weeks. It's not highly likely. In fact, it's probably very improbable that the market goes up for another 12 weeks. But we don't know that. So if you establish a position when you see improving risk-reward ratios, if you're wrong on your time frames, it enables you to participate and adjust as you go. If next week we don't see improvement in the credit markets and we see divergences and things like that, we'll continue to have somewhat of a neutral stance with a high cash position. We have not shorted this market. We have not bought bonds. Why? price has not confirmed a risk-off mode yet. There are plenty of setups for risk-off, but we need TLT, the VIX, and other risk-off assets to pick up the pace and make some higher highs on some shorter-term charts, such as a 30-minute or a 60-minute. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.